The most important thing, paper 7, is getting the growth rate for your company. So we're going to use fairly traditional valuation models. So your biggest input is what are those growth assumptions. And the way I like to do growth rates, so think of it in this term. You have today and you have the terminal growth. And in fact, I think I can actually show you. I like the way I'm going to steal some Darren again. I like the way he did it. I'll share this with you because I think it's very similar to what I'm showing you, but I just think the way he did it actually is really well put together. So this is exactly what you're doing on paper 6 and 7. So he says, what's the value of the existing assets? I'm going to talk about a model I like to use for that. What's the value of the new stuff they're going to do that they're not doing today? The value of growth. How long will it take for this growth value to run out and they just become an existing business? He calls it the steady state. I call it the terminal growth. So you've got the existing business, you got new stuff they're doing that they're not currently doing, but they've done it in the past. You think about a pharmaceutical, you can price all their existing drugs, but the company's a lot more valuable than that. And that's because the stock market assumes they're going to develop new drugs. So that's the value of growth. Or Disney, you can value Disney and what they have today, but you know Disney's going to create new films in the future. How do you value that? And that's the hard part to value of a company. I'm going to show you a model that Darren hates, but I like this model because it helps you figure out this piece here, and then you can see how much of your firm's value is relying on that future value growth, and then the steady state timing, and then the last thing is risk. So that's what we talked about with your beta in paper 6, is adjusting, getting the right discount rate. So I like this approach. It makes a lot of sense, and it's essentially exactly what we're going to do in paper 6 and 7. So 6 is to get the discount rate, and then 7 is to figure this out. Now there's 3 models. You have to use at least 3 models. The 3 that most students use, one's a dividend discount model, where it just combines these first 2, the existing assets and the value of growth. It just combines those into one and adjusts the growth rate to kind of get that all together. So there's only one growth rate. The second one is the capitalized earnings model, that's the model I think really gives you the value of the existing assets. It ignores the value of growth, just looks at the existing assets. I like that model. And the last one's the H model. The H model does all of these. The H model explicitly gives your value of growth, and you have to explicitly say what's the time of that. So I really, really like that. We're going to be using dividend discount types of models. You don't have to use dividends. You can use free cash flow. So if your firm does not pay a dividend, let me know and I'll help you get a number. So a free cash flow model, you can use all 3 of these models, well, 2 of these models, the dividend discount model and H model. You can use them with free cash flow instead of dividends if you like. And we just have to come up with the free cash flow. I'm not going to spend time in class doing that, because it's just this class, we just don't have enough time. If you took Dr. Katapakham's class, he talked a lot about free cash flow. What I'll actually probably do for your company, I might even do that this weekend if I remember, is get free cash flow for equity per share for all of your companies just in case as backup. And to me, free cash flow for equity per share is a good substitute for dividends per share. And so you can use these models. You can use 2 of these models doing that. So there's one last model. I call it the proprietary growth model. Some students have used that. That's if you're doing like a Google or a firm that's just not paying dividends but is growing fast. NVIDIA might be in that category. Then you can value them using this proprietary growth. You can use the capitalized earnings model. So it's possible you may only have 2 models that you can use, but I want you to at least really try. Well, actually, you need to use 3. All right, so good way of looking at it. It makes a lot of sense the way he has it lined up there. And so how do you get your growth? So you have today, how are they growing? And that's why he calls the existing business as is. Then you have the new growth, expansion, whatever. You have the growth that's not part of current assets. They haven't built it yet. And then the last thing you have, I got to move y'all's pictures over. The last thing you have is in terminal growth. That's when they get past the growth stage. And then you got the timing. How long does it take? How long will this expansion, new growth phase last? So if I were doing Facebook, I would probably go country by country and see how many users they have. I think about what I think their ultimate users will be, and I'll think country by country or region by region, how long will it take them to get there? So if they've got 30% of the US market and they only have 5% of India, then I say, okay, I think they'll ultimately get to 20% of India or 15% India. It's going to take them 10 years. I'll do something along those lines. Once Facebook has the entire world, they can't grow anymore. They can't grow by expanding. They can't go to new countries. You know, there's at some point where they've just got everything they can get, and then they're just going to grow with inflation and population growth. They just can't grow any faster than that. Same thing with Netflix. Same thing with Uber. You eventually get, now Uber is starting Uber Eats. Uber is also thinking about, you know, transportation, delivering stuff besides just food. So they have some other expansion ideas that they can certainly put into their business. But at some point, now pharmaceuticals are interesting because pharmaceuticals, you know, you're always developing new drugs. So it's a little bit different, but you kind of get to a normal cycle where you're just developing new drugs to replace old drugs. But that one's interesting. The media industry, Disney is a little interesting because you can always develop a new movie. But you know, so those are a little more interesting. They're a little bit more difficult to value. But ultimately, we're going to think all of these firms are going to have their existing business plus whatever new expansion, new products, whatever they have. Eventually, that runs out. They become a normal business. They have terminal growth. We just got to figure out how long that's going to take. Now, some of y'all may already be in the your existing business may be what you have. So Alicia's doing Whirlpool. I don't know if Whirlpool has any expansion opportunities out there. You're competing, you get some really, really tough companies overseas, so it may not be there. If I were doing Campbell's Soup, I don't think they have much. Procter & Gamble, one of you is doing Procter & Gamble, about probably the only expansion growth they probably could do is the emerging markets. So some of your companies may already be there. Some of your companies may be resizing, and this is where I say the COVID-19 may have to come in. Maybe you give them a negative here, that this is a COVID adjustment for the new expansion, and your timing is when do they get back to normal. So if you're doing like a movie theater chain, yeah, you may have negative numbers, and then they come back to more normal growth. So, you know, there's different ways to view this, and we'll talk through each one. But that's what you're thinking about in paper 7, is you're trying to get the product life cycle of your company and where they're going. Obviously, the new growth is the hardest thing to get. So when we get the growth rates, this is the way I would like for you to think about it. Start with that terminal growth. And what I think on the terminal growth, I usually start with US economic growth as my benchmark. How fast will the economy grow? So we talked about that some in paper 6, and you can use that same analysis. Remember, we talked about productivity and labor growth and inflation. How fast will the US economy grow? I guess tonight in the debate, they'll talk about that. Our economy has been growing really slowly the last 10 years or so, not because of the financial crisis, but even coming out of the financial crisis. Economic growth has been in the 2.5 range on average. It's been bumpy, been lumpy. You know, there's been some 4% quarters, but it's mostly been 2.5. And that's real growth. Add inflation to that, you get 4 to 5% type of growth, not enormous numbers. So here you're probably going to have something in the 4 to 6% range, depending on how optimistic you are or how pessimistic you are. But yeah, this, make sure you know this is nominal growth, not real growth. You have to have inflation there because inflation is part of the growth in earnings. So nominal U.S. growth. So don't think 2 to 3% like we've been seeing. You got to add inflation on top of that and think 4 to 6%. I think 6 is actually a little bit high. Well, you just look historically what it's been. It's been pretty rough. So start with U.S. economy. Step 2 is go back to paper 1 and paper 2 and think about your industry. So paper 1, you came up with your final conclusion on paper 1, is this industry growing above average, average, or below average? And your average is compared to the economy. So if the economy is growing 5%, is this an industry growing above that or below that? And you might think in terms of the cycle of this industry. Where is this industry? Is it early in its development cycle, or is it pretty late? So if I'm doing a Whirlpool, I'm thinking pretty late. I'm doing airlines. Airlines maybe not as late because there's a lot of people in China that are starting to travel, and India starting to travel. Maybe you could even argue Whirlpool might have a market in India, although I doubt it's going to be able to compete against the companies that are there. But you know, think about this industry, and probably your biggest advantage. And you have a few ways to think about it. When you look back at Porter's, you can think of it in terms of expanding overseas. You can think in terms of new products or new uses for existing products. If you're doing an NVIDIA, obviously artificial intelligence, autonomous vehicles, there's a lot of stuff that's really at the forefront that hasn't really taken off yet. So, you know, think in those terms. So go back to paper 1 and really 1 and 2 and see what you said there. So that's your industry. It's a lot of Porter's. Remember, I won't go back to it, but remember we talked about the economic moats. We talked about Porter's and economic moats. So there's an opportunity to go back and reuse what you said there. So don't finish your papers 1 and 2 with, wow, this industry is really struggling, not growing really fast. And then you get to paper 7 and your growth rate's 9.5% for your company. You know, it doesn't make sense. So think about your industry and then think back to what you said in papers 3, 4, and 5, especially 4 and 5. But even 3 is where you talk about economic moats. So what's going on with this firm? Remember, I said the most important part of growth is asset turnover times margin. Are their margins expanding? Is turnover growing? Are they getting more out of their assets? If they are, that means they're growing. And so that's a good sign for growth. That's that sustainable growth. So you might look back at that chart from paper 4, that asset turnover times margin, and just see, is that line going up, or is it flat, or is it coming down? That is probably, to me, the most important driver of growth. If asset turnover times margin has been coming down and you want their growth to go back up, you got to think, what are they going to do to change this company and get better at turnover and margin? So how is the economy growing? How's your industry relative to that? And then how does your company look? That's one of the reasons why on paper 4, I gave you all those industry charts. You know, asset turnover times margin, not just for your company, but relative to the industry, is a really powerful chart. You could bring it back into this paper just to show what you're thinking. There are a few other approaches. Do make sure, if in paper 1 and 2 you said your industry is growing slowly and you think your company is going to grow fast, you need to explain that. Because if your company is growing fast, where the industry is growing slowly, your company is picking up market share. And it's really hard to pick up market share without causing another company to respond. You know, if Family Dollar is picking up market share, that probably means Target and Walmart and Costco are losing market share. They're not going to just sit back and let Family Dollar take over. You know, you might say, well, Family Dollar is all, you know, this local store, small store, and neighborhoods. They're not really competing with Walmart. But if people are going to Family Dollar instead of Walmart, Walmart's going to notice that. And what's Walmart going to do? They'll try to set up those type of stores as well, or do something to go after them. So if your firm's picking up market share, that's where the economic moat is so important. Does your firm have an economic moat so they can really expand like that without bringing in competition. A few other things you can do. This one's going to be tough without access to Bloomberg, but if you can get to the Bloomberg in the library, Bloomberg, you just type EE for your company. That's earnings estimates, and Bloomberg will give you revenue and earnings per share estimates for your company. We talked about that some, I think, when we're talking about paper 5. So you can definitely, so this really relates more to paper 5, but you want to bring that same thought process in here. What are analysts saying? What do they think? I'll show you another way you can bring in analysts. So another way you can bring in analysts is the PEG ratio approach. So if you don't know a PEG ratio is the PE ratio divided by the expected growth over the next 5 years. So when you do the PEG ratio approach, you're actually getting analyst estimates. So if you can't get the Bloomberg, you can get an estimate from Yahoo Finance, and I'll show you how to do it. I'll do an example here. So the PEG ratio is PE ratio, the forward PE ratio, divided by analyst expectations for growth. So if you get the forward PE ratio, you can then say growth equals the forward PE ratio divided by the PEG ratio, and that gives you growth. Let me do an example of that just so you can see it. All right, so here's NVIDIA. So you bring up NVIDIA, and then you go to statistics, and under statistics, it's up here at the top. So you see the PEG ratio right there. I'm going to have to write it down. Let me get a piece of paper. So there's their PEG ratio. Now, the thought on PEG ratios is, I've seen some people say PEG ratios above 1 is the stock's too expensive. And boy, I don't know what they've been thinking. It's hard to find PEG ratios below 1, especially for tech stocks. But NVIDIA's PEG ratio is actually not as high as I thought it would be. 3.45. Everybody see that? Do y'all see in the same screen? I can see that. So I've in the past made a mistake of doing the trailing, but you want the forward PE because the PEG ratio is off the forward PE. Their forward PE is high. It's not as high as their trailing. This is one of the biggest lies we tell in finance. I had a boss that did this. Look how different the trailing and forward PEs are. And that's probably because of COVID-19. You know, their historical earnings are probably a lot lower than what they're expecting next year. But I had a boss, he would pick between the forward and trailing PE depending on what story you wanted to tell. And you can't do that. That's not fair. So the forward PE will always look cheaper for most companies because their future earnings are expected to be higher than their current earnings. All right, so if we go back to, so if we take the forward PE, I'm going to calculate the number here. Y'all can probably already do it, but the forward PE of 51.55 divided by the PEG ratio 3.45, you get 14.94. That to me doesn't seem particularly unreasonable for a NVIDIA. That seems reasonable. So oh, sorry. So for NVIDIA, the PEG was 3.45. The forward PE was 51.55. So the expected analyst growth next 5 years is 14.94. You get 14.94, but it's 14.94%. They don't do it in decimals. They do it. They multiply by 100, so it's 14.94%. So whoever's doing NVIDIA, you could definitely use that as your short-term growth. That's only the next 5 years, so you might need to think further ahead than that. Who knows where autonomous vehicles will be 10 years from now, 20 years from now, or the other things that NVIDIA is really big into. So there's one way to do it. It's possible your firm won't have a forward PE if they're losing a lot of money. So it's possible if the forward PEs, if the earnings is negative, you don't have a forward PE. If you don't have a forward PE, you can't have a PEG ratio. So it's possible a few of y'all won't have that. But that is an approach that should work for 90% of your companies. Any questions on that one? So it's, your boss is probably not going to pay you a lot if all of your assumptions are what all the analysts are thinking. She'll just go out and look at the analysts and save money on your salary. So that to me is just an input. You can look at historical growth, and I'll show you how we can do that. You already have this data in your in your Excel file for paper 4. This is the average analyst that might, who knows, these might be 5, 6 analysts. They're the sell side analysts like JP Morgan. So we can't say for sure that's what all analysts believe, but it should reflect probably consensus numbers. But the buy side's much larger and a lot more people, they're actually buying the stocks. So you can't be for sure, but yeah, you'd probably think if the market, we can say the market's expecting 14.94% growth. We can't be really sure about that because that's only a few people. They're probably the most knowledgeable and the most respected, so they probably carry more weight. It's the same thing if you use the Bloomberg earnings estimates. It's just a few sell-side analysts, so it's not an initial, really the true number. But it should be accurate. Sell-side does influence these numbers quite a bit, and the sell-side people who are actually providing these estimates are probably the most influential. So I would guess if NVIDIA grows at 18% next 5 years, their stock price will do extremely well. On growth, I like to do growth on revenues and on EBITDA. So there's a few ways you can do it. Well, we talked about this last week, didn't we? The last class. Boy, I can't remember what class was that. But you just look at revenue growth year by year by year and just see what's going on with the company. So you have, if you can't get the Bloomberg to pull a whole lot of historical data, you have, and actually more. Don't forget it over here on the side, this 2011. You can copy that as far over as you need to. So for Walmart, actually go back to 2002. So you might have data all the way back to 2002. And in that case, you can get a lot more data. That's, that's 20 years almost of data. So, look at that. If you want to, you can look at 3-year growth rates. To do 3-year growth rates, you just do this year divided by 4 years ago, not 3 years ago, but 4 years ago. Raise that to the 1 divided by 3 minus 1, and that gives you your three-year growth rates. And then you can actually graph that and just see what's going on with your company. You can see I'm going right to left, unfortunately. You can see their growth rates have dropped dramatically. In the last few years, they've been really pathetic growth. That gets some of that noise out of there, but just, they've been growing 1 to 2.5%. They haven't been above 5% growth since, 10 years, 11 years ago. Obviously, Amazon showed up and has caused a lot of that. So you do have some data, and don't forget that you have more than just the 10 years there. You can go back at least to 2000. You can go back to 2002. You can't go back further than that, I'm pretty sure. You can also do 5 years. So to do 5 years, you just do the current year and divide it by, and you go back 6 years, 1, 2, 3, 4, 5, 6. Raise that to the 1 divided by 5 minus 1. There you have 5-year growth. Looks very much the same picture, just weaker. 1.5% growth. They're just barely growing with inflation. Remember, they're barely growing with inflation, even though they're still adding stores. So you're seeing their square foot is still growing, not dramatically, but it's still. Well, I guess it did dip there some. So maybe it's not as bad as I'm leading to. Somehow they have reduced their square feet the last few years. All right. So historical growth is another good way of looking at your company. You obviously don't want to just extrapolate historical growth, but it works. There's one last one that's not in the notes that I should have put in the notes. It's one I don't really believe in, but I'm going to put it in there because it is taught in a lot of college classes, so we need to know it. And that's the sustainable growth formula. What you do here is you take return on equity times your retention rate. That's the formula I was taught. I don't like this formula because it assumes stability in ROEs and assumes stability in retention. So what I really think you should do is normalize ROE times retention. All right. You can use the current retention if you want to. You don't have to shift that. So let me try this with Walmart since I have the numbers. So how would you do normalized ROE? Let me show you how I would do that with Walmart. So with Walmart down at the bottom, the very end, I have on print page 1, line 53, I have the return on equities. You can see how they're bouncing all over the place. So to normalize it, you can do it a couple ways. You could take the average of the last few years. I actually prefer to do the median of like the last 5 years. What the median will do will kick out those outliers. So maybe they grew 5%, 6%, 5%, 32%, 5%. That 32% would distort the average, but won't distort the median. So you can see their ROE has been about 11%. Now, it's also been coming down lately. And their asset turnover times margin is coming down. Y'all see that on line 48. So I might, for Walmart, stick with the 10%, just because it's been declining for such a regular period. But if you have a firm that's really, really, really volatile, you can normalize it real easily just by looking at the last few years and just get a sense of, you know, what looks like normal. All right. So let's say we're going to use 10% for Walmart as their normalized ROE. Just a good round number. So how do I get the retention rate? Well, you go back to Yahoo Finance. We'll put Walmart in there. And again, statistics. And you'll see right here, y'all see this right here? Oh, that I'm not typing Walmart. What did I type in?
Yeah, you put Wayfair, not Walmart.
I don't know why. I always do that, and that happens all the time. I know Walmart has dividends. So. All right, so look down here under the dividend section. Do y'all see this payout ratio here, 34-13? Y'all see that? So 34-13. Can anybody tell me what their retention rate is? If your payout's 34%, what's your retention?
A little over 65%.
Yeah, so round it to 66%. Right, it's just 1 minus the payout. And so for Walmart, let's go back to the class notes. So for Walmart, I'm going to say normalized ROE is 10%. You can just use the median past few years, or take the trend. I took the trend for Walmart. Their payout ratio, I'm just going to round it to 34%. That means their retention ratio is 1 minus 0.34, or 66%. So their growth rate equals 6.6%, or 10% times 66%, 6.6%. Now, how does that compare with their actual growth in earnings? Not very good. Right? The actual growth in earnings has been more like 2%. So these various methods can give you radically different answers. So ultimately, there is no source for future growth. It doesn't exist. There are only interesting inputs. So you could have 4 inputs and they're all radically different, and your assumption's radically different again. So you've got to come up to, so ultimately, It is a forecast. You can draw from paper 5 if you want to. If you've got a really good forecast in paper 5, you can go back to that and figure out what that growth rate is that you're getting out of paper 5. You want it to be somewhat consistent here. There's no way I would use a 6.6% growth rate for Walmart. It just doesn't make sense. I think part of the reason their ROE is going up or is 10% is because of their leverage. And so I think they're actually going to be paying down some of that debt because of their purchase of Flipkart. And so that's actually going to reduce their ROE. And so I think this ROE is somewhat inflated. But ultimately, it's a forecast. So there's a lot of subjective justification for your firm. That's where this economic moat comes in. Life cycle comes in. Where is this firm and its product life cycle? Is this still a young company expanding, or is it a, Walmart is definitely a firm getting close to the end of its growth period, and it looks like the last several years it's not growing at all unless it can find some new thing to do. I'm amazed it's not growing faster just because I can see how radically fast it's growing in Central and South America. But for some reason, that incredible growth there is not coming through in the top line numbers for the company. So these are all approaches for the short-term growth. So if you think about it, your short-term growth, okay, long-term growth, it's going to be a function of economic growth. We talked about that when we did paper 6. And then short-term growth, you have inputs, things like analysts, that's where the PEG ratio works, analysts. You can look at historical growth. You can do the sustainable growth rate, ROE times retention, but make sure you use normalized ROE times retention. You can look at your paper 5, and then you just justify whatever you believe. It is, there's no rules on forecasting, and we know we're really bad at it. So, and then the last thing you're going to do is you're going to have ranges. So one thing I want you to do is have a best or base, best, and worst case. And I'm going to do that when I do the example video that walks you through paper 6 and 7. Just like you're going to have a best, base, or base, best, and worst case on your betas, you have a best, base, best, and worst case on this. On short-term growth, I want a base, best, and worst as well. And maybe, well, we'll talk about the timing. Now, we're going to use data tables. I'm going to show you how to do data tables. Some of you are already thinking data tables, you can only do 2 things in a data table. And now I've got like 6 things going on here. I'll show you one of the models has several inputs. So essentially 1, 2, 3, 4 inputs. And a data table only has 2 inputs. I'm going to show you how you can do that model in a data table, and I'll set it up for you. Essentially what we're going to do is, if you've never done a data table before, it just runs a lot of simulations, a lot of scenarios. If you can adjust 2 things. So on one model, all you're going to adjust is the beta and the growth rate. So there's just 2 things that works. With another model, you have beta, but you also have short-term growth, long-term growth, and the timing. What I'm going to show you is we're going to put those together to create one number that we're going to then run that data table. And I'll show you how to do it in the video, so you'll be able to follow the video and do this. So there is some Excel modeling you got to do, but I'll do it step by step, and you'll be fine in the video. So just trust me on that. All right. So there's our inputs, and then the last thing is timing. And we'll have to talk about timing. Timing is the most subjective, no question. I have students ask me, how do I come up with the timing? And I'm like, your guess is as good as mine.
Is that like how long they can sustain the growth, or?
It's for the short-term growth. So short-term growth, let me put it under short-term growth. Short-term, because long-term growth is infinity. We just assume they're going to grow that forever and ever and ever and ever. Short-term growth, you got to put a time to it. It's just the most subjective. The only input I can give you is 10 years is a long time for high growth. So if your firm's growing fast, like an NVIDIA, 14, 15%, it is very, very hard to sustain growth rates that high for 15, 20 years. And some people say, well, what about Apple? What about Microsoft? What about Google, Intel, Amazon? You look at them and it's actually quite amazing. After about 10 or 11 years, their growth rate actually slows pretty dramatically, mainly because they get to be so huge. But the other thing you got to realize is those are the winners. Those are the most impressive ones of all. So yeah, so 1 out of 50,000 stocks did that, or 5 out of 50,000 stocks did that. You still got 49,995 stocks that couldn't sustain growth for that long. So that's one thing I'll say, just be real careful that you don't get too carried away in the timing just because you think your company's so great. I know Google's been growing fast here recently, but man, they're getting to be $1 trillion company. It's really hard to grow the earnings of $1 trillion company at 10%, 15, 20%. It's just, you're so huge. Everything you do just knocks people over. It's just too much. So think about that. So if you have a small company, and none of y'all have really small companies. So if you have a really small company, it's not that small of a company. So if you have a smaller company, it's gonna be if you have a larger company, it's gonna be tough to justify a long period of high growth. Even with smaller companies though, usually smaller companies, they'll get to one point where something happens, a new competitor comes in, new innovative product, someone buys them out. Even they have an issue keeping that growth going that much. So this is, in a nutshell, this is your paper 7. What I want to show you is the models you're going to use that you're going to input all of these things into. Right. So the other inputs that you need are dividend 1, that you're going to get from Yahoo Finance, or use free cash flow per share for equity from Professor Sweet. I'll help you get that number, unless you know how to calculate it. If you have Packham's class, you can probably calculate it. So you got to get the dividend. You need an inflation rate, but you get that from paper 6. So you already did inflation rate in paper 6. So you've already got that. You need your discount rate. That comes from paper 6. So you've already got that. And I forgot to put this in here. You also need earnings per share 1. So these are all the inputs you need. This you get from Yahoo Finance, or you normalize it. So I can again show you how you can normalize. Let me show you Walmart again. So on Walmart, if you go back to the PACE values for your company, you have earnings per share. You might have to write this down because it's hard to find, but line 35 is your earnings per share. And if you look at Walmart, you can see, man, 2 years ago was a really bad year for them, but they've been averaging 4 to 5. So this is not your forecast earnings per share, it's your current earnings per share today. So you just need, maybe normalize it. I don't think I need to normalize it for Walmart. I think $5 is a probably pretty decent number for them, given what they've been doing recently. They used to be, it's amazing how consistent they've been, $4.50 to $5, except for that 1 year. So you have that number. So if you have a firm, I'm more worried about some of the high flying companies that are really volatile. Maybe they had a loss a couple years ago or whatever, or maybe they have a loss this year. You can't use the number to value companies. So you need to throw out what that loss is this year You got to say, what would they normally make? And using an average or a median over the last 5 years is not a bad way to do that. All right. So you probably don't need to normalize dividends. We're not doing bank stocks. Bank stocks, some of them have cut their dividends to practically zero in some years. So probably don't need to, but if your firm, I don't think I brought in dividends per share on the Walmart. I can't remember if I did or not. I've got dividends, so you might be able to back into it. But if your firm just stopped paying dividends for some reason, you could come up with a normalized dividend. But yeah, it's not gonna. Most of your firm won't have that issue at all. All right, so y'all now see what paper 7 looks like. This is it. Most of it is getting these growth rates and the timing. So that's the biggest part of it. Now the easy part is the models. Sticking these numbers into a formula is really easy to do. So let me show you what formulas that you have to choose from. So the first one is the good old dividend discount model. You should know that one really, really well already. Let me just type these. I'm going to put it in a different page. You have them in the notes, but I'm going to put them all together so you can see them all together. It just makes it a lot easier. So I don't know if it's sharing or not, so I can never tell what's sharing, what's not sharing. So let me. All right. So your first choice, your first one you're going to use is a dividend discount model. Hopefully y'all remember. Anybody want to tell me the formula for that? Is it exactly your long-term growth? Dividend 0 times 1 plus long-term growth. All right, let me show you something real quick. How do you get dividend 0? Because Yahoo Finance has messed this up for us. I don't know why they did this, but it's a pain. So let me show you this real quickly, how you can get dividend 0. So I'm going to go back to Yahoo Finance. I'm going to click on historical data. Well, let me start with the summary. Let me go to the summary page. So if you look at the summary page, on the summary page, they give you a dividend. See this word right here, forward? We don't want a forward dividend. That would be dividend 1, but that's not what this is. So the best as I can tell, what Yahoo Finance is doing is taking their last dividend by 4. And they're saying that's the forward dividend. So I don't want to use that. So I'm going to go to historical data, and I'm going to show you how easy it is to do. So you can show dividends only, and just do dividends only. And these are their, so what's their dividend? You just add these 4 numbers together. All right. So that's it. So you saw that they showed a 216 as their forward dividend. They just took that 54 cents and multiplied by 4. That's a nonsensical number. It doesn't make any sense. Let me show you another company just so we can make sure. Let me try Whirlpool. I got them on the mind for some reason. I don't know that much about them. So Whirlpool. Let's do dividends only again. Apply. Wow, they pay a really good dividend. Well, maybe not for $194 stock, but so Whirlpool's dividend would be what? It's not $1.20. It's what? $4.80, right? You add those $4 together. You may want to do one of your companies just to double check.
Can you do Apple, sir?
Yeah, Apple pays dividends, but I don't. Yeah, who's doing Apple again? I can't remember.
I am.
Joseph or okay. Yeah, Joseph, you might want to actually use free cash flow per share for equity. There's no dividend reflects their free cash flow. It's way too low. They could pay a much larger dividend than they are. My fear is if you use dividend, some of y'all may have this problem. You know, try the dividend discount model, and if you get a price for Apple of like $22, that dividend just doesn't really. That's what we're thinking. You know, that's what finance is arguing, is that the dividend they pay they're paying out their free cash flow. That doesn't really apply to Apple. Apple has a lot more cash flow than what they're paying in dividends. So I think you'd come up with a really, really low valuation, but that would be it. You just add those four numbers together, and that's their dividend.
Do they just have a really low payout rate?
Well, part of their problem is they got money stuck overseas that they don't want to pay tax on. They still have over $200 billion. So obviously, you just look at their dividends, and you can even see it. Just look at their cash flow. It stands out pretty dramatically. So let's see if we'll flip over here. Cash flow. So their cash from operations is $80 billion, and yet their where's their dividends? Well,
Or would it be the
here.
dividends paid?
Do you see dividends paid? I don't see it yet.
Yeah, right there. Cash dividends paid down there.
Net common stock. Why don't? Oh, there it is. Cash. Okay, there we go. Thank you. All right, they're only paying $14 billion in dividends. Their cash from operations is $80 billion,
Like 15% payout.
and their CapEx. I mean, yeah, it's ridiculous. Their CapEx is only $8 billion. I mean, where's all this money going? So, yeah, I mean, it's just ridiculous that a firm with $80 billion in free cash flow is only paying a $14 billion dividend. That's not their official payout. The payout's the dividends per share versus earnings per share. You don't do it versus cash from operations, although that wouldn't be a horrible thing to do. So yeah, I really don't think Apple, you're going to get good valuations with Apple, and a few other of you might have that issue. So if you get to your valuation with the dividend discount model, you get a ridiculously low number. You might be a candidate to substitute free cash flow per share, and that's something I can calculate for you and send it over to you. I don't want to. You get that in Catapacum's class. I don't want to deal with it here because it's just too long of a discussion for this class. All right, so yeah, that's how you get your dividend zero. It's not a difficult number to get.
Excuse me, sir. Why would they? Maybe I'm just not understanding, but why would they put the forward dividend is the same as last year's dividend, and then they kind of put like a percentage next to it? I'm just kind of like, why don't they just call it the
Well, the percentage is the yield,
right?
So that's the dividend. I don't know why Yahoo used to do the trailing 12 months on the dividend, which is what we want. If they do a forward, it's kind of confusing because that implies it's some forecast for the next 12 months, but it's not.
Right.
It's just last quarter times 4. So it's really just a nonsensical number. I don't know why they did any of that. But ask your question again. I might not have. It's not the last 4 quarters. It's only the last quarter times 4. So they're not even in the trailing 12 months. It's neither a forward dividend or a trailing dividend. It's just a nonsensical number that they decided to throw in there. So I don't know why that's the case. Are we still on Apple? Yeah, you can see Apple's dividend yield is only 0.7%. That's
Professor, we're still on the Word documents.
Oh, I'm sorry. So yeah, so Apple's dividend yield is really, really, really low. So all right, let me go back here. So there's the first model. The second model is what I called capitalize. Earnings model. This one you have to explain. It's in the notes, and you can quote me on this because everybody knows the dividend discount model. The other models we're going to talk about, people know those. No one's going to know what you mean by capitalized earnings model. That's my title. But the argument here is, let's assume they pay out, assume the payout ratio is 100%. That is dividends equals earnings per share. We're going to say this is going to limit growth, not the 0% like the sustainable growth model does. We'll say this limits growth. I'm going to say to inflation. My argument there is if they pay out all the earnings, they can't reinvest in the firm to grow, but their revenues should grow with inflation, their expenses should grow with inflation, and so their earnings will grow with inflation. And because they have depreciation expense, they do have some cash flow they can reinvest just to keep things maintained. And so that's my argument. I can't prove this anyway, but essentially what I'm looking for here is the value of the as-is firm. No expansion. Because they can't expand, right? They're paying out all their earnings. They can't expand. So it's just as is. And the formula for that is earnings per share, 0 times 1. Here's where you need the inflation rate, 1 plus inflation divided by KE minus inflation. Exactly like the dividend discount model, except for we're going to use earnings per share instead of dividends because we're paying out all of our earnings per share. And because that's going to limit our growth, we'll limit our growth to inflation. And I like this as a good idea of just saying, hey, this is probably what the firm's worth if they didn't build any new stores, they didn't do any new films, you know, they just kind of stayed as is, didn't build new theme parks. So that's the cap, I call it the cap earnings model, the capitalized earnings model. Since we're going to take the earnings and just capitalize it, we're going to make it an asset, and we're going to sell that asset, and this is what it's worth. The next one's my favorite, and that's the H model. So the H model is the dividend discount model all over again, but it's going to let you put in a higher growth period. And so what we're going to do is take the dividend discount model, we're going to add a growth period to it, a hyper growth to it. We're going to take dividend 0 times something called H times short-term growth minus long-term growth. And here's where you use your short-term growth number. All right. So the first part of the formula is exactly the same. The last part of the formula is exactly the same. You take dividend 0. So the only thing we have here is the H. So what is H? H is the half-life to get from short-term growth to long-term growth. So if you say a high growth period will last 6 years, what is your H? Your H is 3. Okay. And then you just take your short-term growth rate minus your long-term growth rate, and there's the formula. Make sure you have your parentheses in there. So it's a fairly straightforward model. I found it in the footnotes of a paper for the CFA exam when I took it. I haven't seen it used as many times. I see people using the multi-stage growth model, and I don't like that model. It's just too cumbersome. It's kind of ridiculous. So I don't recommend you use that model. But that's the H model. Any questions on the dividend discount model, cap earnings model, or H model? The one thing to be real careful of, your long-term growth must be, I'm not saying it should be, I'm saying it has to be less than your KE. You have no choice on that. You can't have a 10% growth rate and a 6% discount rate. Your short-term growth rate can be higher, but your long-term growth rate cannot be, you cannot get a negative number in the denominator on these formulas. If your long-term growth is greater than your discount rate, the firm's worth infinity, and I don't think any of your firms are worth infinity. So be careful on that. Now, the other thing we can do is on the dividend discount model and H model, you can use free cash flow per share for equity. Now, if you took Dan Darren's class, he probably valued the firm using free cash per share for the company. You value that using the cost of capital for the firm, and then you subtract out the value of debt. I don't know if you remember doing that in his class or in a class like that. I don't want to do that in this paper because I don't want you to have to mess with cost of capital. I don't want you to have to go out there and find cost of debt and all that. It's just too much work. We already got enough on our plate as it is. I've had a few students actually do that. If you absolutely are adamant you want to do that, that's fine. Free cash flow models are considered to be the best models to use for valuing the firm, but they also give the worst answers. And so I'm not a big fan of using them for that reason. They give some really squirrely answers, and part of it's because it's just really hard to figure out what the free cash flow is. But free cash flow per share, so essentially free cash flow per share for equity is taking free cash flow of the firm, subtracting out interest expense, and then doing it on a per share basis. So if you subtract out the interest expense, it's now for equity, so it's free cash flow for equity, and you can use that to value the firm. And so if your firm doesn't pay dividends, that's why we can substitute that for this. You don't need it for the cap earnings model because you're using earnings per share, and hopefully your firm has positive earnings per share. Okay. All right, the only last one is a proprietary growth model. And this is a file. Let me put it up here with everything else. So this is a file on Blackboard. Let me go find it real quick. But so if you look out on Blackboard and you have a firm that's not paying dividends, it's in their content. So let me load it real quick. All right, so let me share this so you can see. It's actually a fairly simple model. I did it for Google. So what I do for Google, it looks a lot like the H model. Looks a lot like the H model. What I did is I entered their current earnings. You can get that off of Yahoo Finance. Here's my H, essentially are 2 times my H, 20 years, so my H would be 10. So 20 years to get from long-term growth. So I'm using 6% for their long-term growth. I'm doing their starting growth at 25% because Google has been growing really fast recently. Here's my discount rate down here, 9.6%. The only assumption you have to do, everything else is just like in the H model, except for you don't enter H here, you enter 2 times H here, you do the actual years. The only thing is the ultimate payout ratio. So here's how this model works is I'm going to say, okay, Google, you're growing fast. As long as you're growing fast, you're not going to pay dividends. But as soon as your growth rate hits that long-term growth rate, you're going to start paying dividends like a normal company. A normal company pays about 40% in dividends. So if you look at this, just entering, you don't have to enter many numbers. And most of them you have, from paper 6, you just enter those from paper 6. So when you do that, you notice dividends are 0 as their growth declines over 20 years. But as soon as their growth rate hits 6%, they start paying a dividend. And I just take the present value of that. I get a valuation of 1540. I don't have any clue what they're trading for today. Let me look real quick.
1490, I think.
Yeah, I don't think they're quite up to. So, oh, I got gold. I don't know why Yahoo Finance can't give me the company I type. Oh, they're actually 1606. Wow, they must have zoomed up here recently. So their actual price is 1606. So it gave me a different valuation, a decent valuation, but that's just pure luck that it worked out like this. So if you want to use this model works. Essentially what this is, it's another model like the capitalized earnings model where you can use earnings instead of using dividends. And it works really, really well. So I like this model. It's essentially the H model. It's just that you start with 0 dividends. So I think it works. It should give you good valuation. So you can definitely use this model if you'd like. It's out there, and the assumptions are, I think, very straightforward. So you need, I'm going to say you need 3, but if you can only do 2, then do more analysis. The other thing you're going to do is you're going to do a data table. And I'm not going to show you how to do the data table in class. I'm going to do it in the video, so you just have to watch the video. If you've never done a data table, trust me, it's not that difficult to do. And we'll do the data table on all models. Now, if you use the proprietary growth model, you'll have to run your own scenarios. So you just have to change your assumptions and keep collecting the data as you go, because it'd be tough to do a data table on that particular model. But all models except the proprietary one model. So, and now you have something you can use in an interview. You can say, yeah, I was valuing my stock. I was using this proprietary quantitative valuation model. That just sounds impressive. So, you know, even if you didn't build it, it sounds impressive. All right, that's what I have for tonight. I'm going to do all of this in that video and help you through paper 6 or 7. So if you're still shaky on paper 6 and 7, I think when you see that video, you'll be a lot more confident and see that 6 and 7. I'm not saying they're easy papers, but they're very straightforward. The hard part is coming up with your assumptions, but once you get the assumptions, it flows pretty easily, and you can build all this in Excel. So any last questions here? All of this is in the class notes. The class notes do talk about a couple of other models that we won't use. Contingent claims, there's just no way we could do contingent claims in this class. It's just way too complex. Any final questions or comments? All right, so finish up papers 3, 4, and 5 this weekend. Next week, we'll have Zoom sessions on Tuesday, Wednesday, and Thursday, depending on your team. If you absolutely can't meet with your team, then we'll just have to set up a one-on-one or 202 or whatever. We might, the ones that just can't meet with their team, we'll try to get those people together in one call all together or something. But I do want you on the Zoom just to make sure everybody's knowing exactly what they need. I've had one student send me his paper 4, and I've been going through that with him. He's the only one that sent me his paper 4, and he was in pretty good shape. He had like 4 or 5 areas I told him you need to look at, but he was in pretty good shape. So I would get all these papers done this weekend, and then you're probably over 60% through the class if you get that done, and it's just smooth sailing at the end. All right, I'll stay on if y'all want me to, but otherwise we're done. Y'all can get off and see what fireworks are going on the interview. I mean the debate. What most people do is they take cash from operations, subtract CapEx, and cash from operations already has interest expense out of it, so it's already equity, and you just divide that by the number of shares they have. So if you want to try it yourself, you can do that. It's pretty simple to do.